The Indian share market has been falling for the past 5 days. Now, during these 5 days, Nifty has fallen around 700 points. Apparently, Nifty is 1,100 points below the record high of 20,222, which it attained on the 15th of September. Now, it is expected that the interest rates may be hiked again in the United States. The reason for that is because inflation is hovering somewhere in the US above 2%. In order to tame this inflation, the US Central Bank, which is the Federal Reserve, is increasing the interest rates. Now, it is expected that this year the Fed may hike interest rates once more. So, with the increasing interest rates, US bond yield and the dollar index is also on an upward journey. Now, what exactly does a bond yield mean here? Well, a bond yield means the return you get on bonds. Now, due to the rising interest rates in the United States, for the first time in 19 years, there is a negative gap between the Sensex and the US 10-year bond yield. Now, what that means is that foreign investors, especially those coming to invest in India from the United States, are getting higher returns in their home country without taking any risk, and in many cases, even higher than what they get from shares in our country. Now, this is the reason why foreign institutional investors have been consistently selling in the Indian markets for the past 2 months. Now, if you look at data, so far they have sold approximately 25,000 crore rupees worth of investments during these 2 months. This, however, is in contrast to the trend of continuous buying by them in the previous 6 months before September, as you can see in these numbers. So, what can we expect? Well, the hope for a rapid decline in US bond yields is quite low, as per the recent statement by the Federal Reserve Chairman Jerome Powell. The battle to control inflation will be prolonged, and achieving the 2% inflation target will take time. About 40% of experts believe that there might be a 1/4 percentage point increase in interest rates in the next policy meeting, which is scheduled to happen in December 2023. So in this situation, the big question is whether selling by foreign investors in India will continue. Well, to answer that question, we have a share market expert, Ambrish Baliga, who believes that due to high interest rates in US and increased geopolitical risks, selling by foreign investors will continue. Besides this, Indian market has witnessed a good rally, and due to that, valuations are expensive, specifically for small and medium shares. There is stability in currency, which provides a good opportunity for profit booking for foreigners. If foreign investors continue to sell their holdings, it may exert more pressure on the companies in which they have the most significant holdings. Now, before addressing this question, let's take a look at which companies have a higher stake from foreign institutional investors. Now, according to the shareholding pattern of BSE 500 companies in the past 3 months, there are 27 companies in which foreign institutional investors hold 35% or more. Now, out of these 27 companies, which is the 27 companies in this BSE 500 list, 13 have seen an increase in foreign institutional investors' trust or holdings in the past quarter. In the list, HDFC Bank and 5-Star Business Finance are 2 companies where there have been significant changes in shareholding. On the other hand, among these shares, 14 names have seen foreign institutional investors gradually reducing their stakes over the past 2 quarters. Now, in this group, Paytm and PB Fintech are 2 names where there has been a decrease in holdings of approximately 6 to 12% in a single quarter. Now, the big question is, what should be done with companies where foreign institutional investors have a significant stake? Will we see more fall in these companies as the market continues to weaken? Well, according to Ambrish Baliga, there is indeed pressure on these shares, but continuous buying from mutual funds through SIP investments has provided some relief. Therefore, although pressure may persist, significant declines are not expected, especially in large cap shares. However, due to the negative sentiment, smaller and mid cap shares may experience more pressure. For now, there may not be an exit recommendation for any particular share, but considering a 12-month perspective, which is a 1-year perspective, buying on dips might be considered for Zee Entertainment, Amara Raja, Piramal Pharma, Delivery, with the aim of achieving an average 25% return. So in summary, it is possible that funds may shift from India to the United States for a while, which could put pressure on companies with significant foreign institutional investor holdings. Therefore, it's advisable not to panic and sell in haste, but to wait for sentiment to improve and potential market corrections before making any new purchases.